So is this expected? I think a lot of analysts were kind of predicting this type of outcome. Your thoughts on that?
Definitely. I mean, we definitely went into this knowing that we were expecting rather poor results, not as poor as what came out. I mean, we expected a contraction of between 0.1 to 0.5%. So 0.6% is a bit out of that range as well. But again, we're looking at this for this quarter. We're expecting something similar for next quarter, and we really need to see some improvements from government side in terms of policies and that to change the situation and that on their side.
Now, mining was one of the big drags, a contraction of 6.1%. Why is that?
So there was just lower production from a mining perspective, low production from the platinums, from the coal miners, as well as from the iron ore mining sectors. So all of the mining sectors were down on that side, with the exception of gold. Gold did have a bit of a positive effect, but I mean, if 3 out of the 4 are down, it's going to have sort of a negative effect. Same with the manufacturing side that you saw. Manufacturing was down about 3.9%, but because it's such a larger component, that 3.9 was sort of the equivalent of what mining 6.1 was to the GDP numbers. So both of them sort of affected the GDP numbers equally.
Now, one of the main reasons attributed to the manufacturing production decline by this 3.9 is largely because of the lower production rate in basic iron. Do you think this is a trend that we should look forward to, or is this more of a once-off?
Well, I mean, it could be interesting to see, given that the current space in the ore space and the mineral sector. If you look at our export numbers, we've been exporting more minerals out of South Africa. So from the GDP numbers, we had higher export numbers. We did have lower import numbers for mineral products as well. So I mean, this could be a once-off thing. Our mineral sector and our mining sector could recover from that. But they do weight such heavy weighting with regards to our employment and all of that, and that's what affected the manufacturing. Is once the minerals have been extracted, the processing and that sort of thing is where the heavy costs come in there as well.
Now, if we look at transport, storage as well as communication, I mean, they also found themselves pretty much in the back burner with a decline of 5.4%. Your thoughts on that, as well as the factors, I think, that have influenced such a decline?
Well, I mean, it's interesting to see. This is the biggest decline that they've had since 1993. So it is quite a significant decline from their perspective. And I mean, if you look at what's driving that, the cost of transport, the demand for transport as well has really declined over the last year, over the last quarter especially. And from a communications sector, I mean, you'll see that there's a lot that goes into the communications, from whether it be from the mobile regulators, from the local side of things, from the postal services as well. There's been a lot of shifting pieces from the government's perspective in terms of their communications, as well as from the private sector. So that really has taken its toll on those industries.
You know, some economists have said that South Africa is really going to struggle to achieve this 0.5% growth for 2019 in general. What are your thoughts on that?
Well, I mean, if you look at where we're sitting at the moment, we're up about 0.1% overall year on year. And I think if we then have one more quarter to get another 0.4%, we're going to need a really, really big quarter from everyone. And given where we're sitting at the moment, given the uncertainty around our SOEs, given what we're heading into 2020 with the budget's speech coming out in early 2020, I think it will be a rather difficult year. I think it will be difficult to achieve that growth. But I think if we can get to a point where we do achieve a higher growth, if we get to 0.2, if we get to 0.3% growth, it won't be the 0.5 that we've desired, but it will be some form, a step in that direction and a step in the right direction. I think it'll set us up quite well for 2020 as well.
I mean, traditionally, looking at the performances of the fourth and final quarter, do you think that this time of the year, the next quarter, would be enough to bolster the economy?
Well, I mean, traditionally, if you look at this quarter, businesses are sort of winding down for the festive season. Mining operations are winding down, production, manufacturing, all of those sectors are going to sort of wind down going into the final end of the year, the festive season. What you might see pick up is expenditure from consumers and that sort of thing. And we did see a bit of that come through in the latest numbers. So I think given the historic setup and what we've seen in the past, I don't think we'll get to the 0.5, just purely because it's towards the year end, everybody's sort of winding up for the year. We'll start up again in early January, maybe early February for some companies next year. But I think it's going to be difficult to get a big quarter out of the final quarter that's coming up.
I mean, as you mentioned, business is closing down, so all the major industries really will be unproductive for a large part of the final quarter of the year. You mentioned consumer spending and how that might influence GDP. How much of a spec does it actually make in the overall spectrum?
Well, not nearly as much as the mining and the manufacturing sectors. I mean, if you look at what we recently what came out now with the final household consumption expenditure, that only contributed 0.1 percentage points, whereas your mining and manufacturing sectors contributed 0.5 percentage points. So, even though that was up about 0.2% in this last quarter, it did still contribute quite a minimal amount towards the overall GDP figure. So I think it's definitely going to affect us, given that we're not going to have that production and we're not going to have those businesses contributing in this final quarter.
What for you was the highlight of this report? Is there anything that stood out that you said, okay, this is perhaps a bit of light at the end of the tunnel?
Definitely. I mean, we saw that gross capital formation increased by about 4.5%, which just essentially in a nutshell means that we're employing more capital resources here, which means that we're increasing our local production and relying less on imports, which you then saw filter into the fact that imports were down and exports were up. So there is light at the end of the tunnel. It makes me very positive to see that we're investing more in ourselves locally, relying less on foreign investments in terms of importing from them, and relying more on using the foreign investments to assist in bolstering our own economy. So, I mean, that was very positive for me to see.
What are two things that you think would really go a long way in bolstering the economy?
Well, of course, the restructuring of our SOEs is definitely a contentious topic, and that's definitely an area that we can look at. Because if you look at how that filters into the GDP numbers, is that filters in where we look at government spending, where we look at government increasing employment, those government figures and government's contribution towards the GDP, and that comes largely from its SOE. So I'd like to see a lot of change happening around the SOE sector. And then from that perspective, I think that ties in with how the government would then do that, involving the private sector in terms of getting their input in a lot of what happens with SOEs. I think the private sector's got a lot to give. I think they've got a lot to contribute towards growing the economy and bolstering the economy. And I think a bit of a bipartisan relationship would go a long way in terms of getting that outcome achieved.
How big of an influence are the state captures really realistically?
Well, I mean, if you look at the state of our SOEs at the moment, most of our SOEs are quite indebted. Very few of them are actually turning a profit. And when they do turn a profit, you've still got heavy financing costs, heavy overheads and that sort of thing. I mean, SAA alone, if we look at that, they've got about 12.7 billion rand of debt. And they've now said that they require an additional 21.7 billion rand of working capital investments in terms of getting their turnaround strategy off the ground and that sort of thing. So there's a lot that's put into those sectors. There's a lot that's put into our SOEs. And I mean, I think that what's concerning for me is around some of the issues that were mentioned by the report and some of the issues that were brought to light by the report.
And we'll talk about some of those issues in a little while. But the committee has asked for support and is going to be asking for support from public enterprises. When we talk of support, what is that likely to look like?
Well, I mean, they would want to see structural reform in some cases where there is structural reform required. They'd like to see policies being changed from the government side where there is policy requirements there. I think the report is going to table a number of recommendations from their side, a number of key areas that they would like to see improvements on. And I think from the government's perspective and from the public enterprises portfolio perspective, they would then need to take the recommendations to heart and see how we then impact and include those in the, as I mentioned, the 2020 budget speech that's coming out in Feb.
Now, talking about those recommendations and those reforms, a large part of those reforms would also obviously involve SAA. What are those likely to be in the case of SAA?
Well, SAA, for the most part, has said that they want to look at restructuring some of their management and restructuring some of their operational setups, just so that they can increase their revenue and decrease sort of the operational costs that go into running the airline. The airline is, as you know, it's quite a costly airline to maintain, and they have said that they want to look at reducing some of their overheads, reducing some of the costs that really go into keeping the airline up, and also driving revenue, getting more passengers in the seats, getting more flights going, maybe increasing some of flights between destinations and that sort of thing as well.
Now, taking a look at the report again, Eskom also came up. And one of the things highlighted in the report is that Eskom actually doesn't have any contingency plans Your thoughts on that?
That was an area of concern for me. That was quite a big area of concern to read that the report has found that they don't have any contingency plans for blackouts. They don't have contingency plans for what they plan to do. I mean, we've just had a bit of change of leadership in Eskom. We've got a new CEO coming in. And I think now is going to be a very critical time, given that the ratings agencies have also said that they want to see a strict and actual turnaround of our SOEs come the February budget speech. To avoid that downgrade. And I mean, if we do have something that leads there, if Eskom is unable to turn it around, if SAA and other state-owned entities are unable to show a positive improvement or at least steps towards a positive improvement, I think what we could see is rather disastrous effects on our economy as well as our bond markets as well.
I mean, we really are seeing the effects of state capture in so many areas and pockets in our society, in our economy as well. But do you believe that the effects of state capture can be reversed, and if so, how? Oh,
definitely. I mean, in as much as the negative effects were quite significant and they were there for a long period of time, I think if we look to government and we look to the private sector as well for some assistance to really put in place measures to actively turn it around, I think we can definitely turn it around. Yes, there were some significant negative impacts. Yes, there were some areas where it may look as though the state-owned entity has failed entirely. But I think with just a bit of change in leadership, change in structure, and positively implementing the policies. I mean, we've got a lot of policies that we've discussed. We've got a lot of policies that have been tabled from government side and tabled to Parliament, but we've yet to implement them on a significant scale. And I think the moment we then get to implementation and we then get to how we then get to robust implementation, we can then definitely turn around what's seen as the effect that we've had.
Let's look at another one of our top stories now, and this one in relation to MTN. Now, we know that the Data Market Services Inquiry report, well, that's one that we've just spoken about now, but MTN and Vodacom and the Competition Commission has come out saying that they need to slash their prices by up to 50%. And that had quite a disastrous effect in the share price. I mean, the duo collectively lost about 22 billion rand of their combined value yesterday. Clearly a sign that shareholders were not impressed with that. Your thoughts?
Well, definitely. I mean, if you look at the effect that it had, MTN was down about 8%, Vodacom was down about 7.8% as well. And what you then saw there was that the result of that Competition Commission ruling, especially given that MTN and Vodacom collectively hold about 70% of the mobile industry in terms of market share, they are the big players. So anything that affects them will definitely have a significant impact on their share price, on consumers, as well as on our industry. I mean, from their side, as providers, they've cited that it's more to do with the spectrum allocation from government's perspective, from ICASA's perspective. In part, that would be true. I think I would agree that they would need greater spectrum allocation. But at the same time, if you look at some of the figures and you look at the fact that the pricing from MTN and Vodacom in countries like Ghana and South Africa, I mean, there's about a 200% price difference where you're pricing at about your average gig in Ghana costs you about $3 for MTN. It costs you about $10 here. So there is a big difference and I think that's where the Competition Commission is coming from, is that they've acknowledged in part that the providers are able to provide this at a reduced cost. Obviously, from the provider's perspective, they're saying that they need more from the government in order to provide this at a reduced cost. They've also said that...
But practically, do they actually really need more from government in order to be able to reduce the cost? Because as you say, if you look at comparative prices on the rest of the African continent, they're able to do that, even perhaps without the support that they're wanting from the other African governments.
Well, I mean, what's interesting to see is they're able to do it in countries like Nigeria, where Nigeria has a population size almost 4 times the size of South Africa. Yes, they might not be as big a player there, they might not have as great a market share there, but you look at a country like Lesotho, where one of the providers is basically a monopoly there, and they're still able to come in at a reduced cost and even cheaper than where we are as South Africa. Yes, you might be catering to a smaller percentage of the population, and you might require greater spectrum to reach other areas of the population, particularly with the landscape in South Africa and the way everything's set up. But I do think that there is definitely scope for them to reduce the costs. I definitely think that they can look at that and they can come down in some areas there.
I mean, there also have been, allegations of collusion between the two huge companies. The fact that even if you move from Vodacom to MTN or you use from MTN to Vodacom, it's still much of a sameness because they've pretty much colluded and have agreed on what the set prices would be. Your thoughts on that?
Well, I mean, like I said, between the two players, they control about 70% of the industry. So, I mean, even if you go beyond the two of them and you say you go to someone else, you're still only dealing with someone, assuming that that third or fourth or fifth player has the rest of the market share, you're still looking at the fact that they do have the ability to collude. But I think if we look at the Competition Commission and what they set out to do, if they were detecting sort of concerns around the collusion space there, they would definitely look to investigate that as well. From MTN and Vodacom's perspective, I think it's difficult from their side as private business to then you need to look after your bottom line, you need to look after the fact that you are at the end of the day running a business. But from a government's perspective, from a consumer perspective, the consumer spend and the available consumer spend, we have a lot of people in South Africa that are too poor to afford what MTN and Vodacom are offering. And you'll see that, the collusion aspect comes from the fact that they're able to offer cheaper rates for longer term, but they're more expensive if you look at a 30-day bundle, for example.
Now, both Vodacom and MTN said that they're now studying this report. Is any of this binding for them?
I believe there will be some binding implications from that perspective. I haven't thoroughly dissected the report myself, but I believe with the Competition Commission's rulings and recommendations, they have up to 2 months to comply, and then from there the Competition Commission could look to take further action if MTN and Vodacom haven't responded accordingly. I think there might also be scope for the two providers to then lodge their own objections in line of this. I mean, they've already come out and said that the report itself contradicts what ICASA has said about their industry and that sort of thing. So I think they'll use a lot of that and a lot of the information from previous reports to sort of stamp down their position and say, look, from our side, we're doing what we can as providers, but we need assistance from government in this respect.
Here's another story that I'd like us to touch on while we still have a bit of time. Now, the National Treasury has gazetted the carbon offset regulations. Now, South Africa is the world's 14th largest emitter of carbon dioxide, as well as a signatory to the 2015 Paris Accord. Now, that Paris Accord aims to transition to a low-carbon future. The Carbon Tax Act was signed into law by President Cyril Ramaphosa in May and came into effect from June. So, Jimmy, won't you just, in a nutshell, summarize for us what the carbon offset regulation is?
So, I mean, we've got, as you mentioned, the carbon tax came into law and the act came into law in June, and it was sort of finalized in Parliament in May, just a month earlier. And basically what they've since issued is 2 further draft regulations around 2 pieces of sort of regulation that they want the government, the public to sort of weigh in on, and that is the allowance for trade exposure, as well as an allowance that relates to greenhouse emissions. So these 2 allowances, looking at both of them, you look at the emissions one, for example, they're offering about 95% of emissions reduction, so they're offering a tax-free incentive there. So there's 2 additional pieces of legislation that have now gone to the public for consultation with regards to these carbon emissions taxes. They want to then implement these by the first quarter of 2020 and time it in line with the Department of Agriculture and Fisheries' report on the emissions that they need to release in February as well. So we've got these 2 pieces of legislation that are going to be looked at over the next 2 or so months, and they're open to the public for consultation around that.
Now, the initial version of these regulations, there are a couple of changes between the initial version and this one. What are those?
Well, I mean, like I said, if you look at what's come out with these 2 pieces of draft regulation, the one that relates to the greenhouse emissions is basically aimed at bolstering firms to reduce the carbon emissions that relate to their production processes and that sort of thing. And the incentive that's being offered there is a huge tax incentive. There's a huge, as I said, the tax-free allowances go up to 95% in some areas there. So initially when this was discussed, this was never put forward to the table. And I think what the government is aiming to do with this is they're aiming to sort of get firms and industry to be the forefront of reducing their carbon emissions there. And then that will, as a result, reduce them overall. I mean, as we mentioned earlier with the GDP numbers, you know how big sectors, manufacturing and mining and our firms play in our economy. And so if you can sort of get them to start reducing their carbon emissions first by rewarding their side of things, we can definitely get to what we need to achieve in line with the Paris Accord.
Well, I think we'll leave it at that for this afternoon. Certainly a whole lot more. There's the NHI that I wish that we'd had time to talk about, but that for another day. We thank you so much for your time this afternoon. That was Jimmy Moyaha, market analyst at Axie Trader, taking us through some of the market